These are keys to being a successful investor and keys to having a successful retirement and being able to do the things you would like to do for as many years as you would like to do. So financial freedom and retirement. Let's start with stocks mostly. When I say stocks mostly, we know that over time, the best elixir to fight against inflation is owning equities, right? Not only have stock prices, if we're looking at the S&P 500, grown at, on average, depending on the time period you look at, let's call it 10% on average over time. The last 10 years has been even higher than that. But let's say 10%. That is way above inflation. And that is what we're trying to do here, is being able to make our money and our purchasing power last. So remember, mathematically, if we make 10% a year, that means our money doubles every, call it 7 to 7.5 years. So that in itself is powerful. However, not everybody can have 100% in stocks just because of the volatility of it, particularly as your balances get higher and higher and you get closer to retirement. A 5 or 10% move in stock values can be jarring for folks. So when I say stocks mostly, even though I think that's our best, one of our best long-term inflation fighters, is that we want to have some level of what I call dry powder, which is just safety assets. This can be bonds, it can be treasuries, it can be money markets pay a fair amount right now, 4 to 5%. So we know that if we have some dry powder, it allows us psychologically to deal with the ups and downs of stocks. So the dry powder part of this is that ideally, and you don't have to do this right away, but as you get closer to retirement, if you look at your overall allocation, you may want to have something like 3 years worth of dry powder when it comes to spending. So if you're spending $50 a year, $50,000 a year times 3 is $150. So of the portfolio, I think it makes sense to have about 3 years worth of dry powder. So on $1 million, that'd be 15%. At $500,000, 3 years of spending would be closer to 30%. So that's stocks mostly. The second piece here is massive diversification. The good news here is that in any given ETF, when we look at some of the broad market ETFs, the S&P 500, as an example, has 500 companies. Many total stock market indexes have 3,000 or 4,000 stocks in them. So we can get diversification in a really big way, better than ever today. The third piece here, again, these are all almost equally important. You almost have to have all 5 of them for the whole journey to really work, but is patience and longevity. And if we think about, you cannot avoid hearing about the price of gold or the price of Bitcoin or the price of the best stock that's performing or what has done really well this month. So we're always getting pulled to do something else because there's almost always, in fact, I would say there's always some investment that's doing better than the investments you have. And that pulls us as investors, just humans, we're humans. We want to do the best we can. So we're often pulled into something that is already done well. And we abandon what can be a tried and true strategy. And we all turn into a guy we all know. His name is FOMO Freddy. He's the guy at the cocktail party that always has done better with his investments than you. Your 401k, it's been a great year. It's up 20%. Well, FOMO Freddy's been in Bitcoin all year and he's up 100%. So there's always something better. And we not only do we not want to be FOMO Freddy, we want to avoid FOMO Freddy at the cocktail party because he's always going to feel like he's going to always make us feel like we're missing out.
Yeah, plus he sounds annoying.
He's the worst. You get cornered by FOMO Freddy. The next piece of this, and this to some extent contributes to FOMO Freddy, is that investing is both easier and harder than it's ever been. It's easier because there's low-cost products and there's thousands of them to choose from. So that makes things easier than the 1980s. There's all of this information that's out there that also makes things somewhat easier, but it also makes it harder because you're pulled in all these different directions. And then the headlines of the world about what is about to go wrong or what is currently going wrong, that permeates to everything. So it makes it really hard for stock investors because you can always make a case that, hey, the world's about to fall apart. That means the stock market's going to go down. The economy's going to go into recession. There's a jobs number, an inflation number, what the Fed's doing. So we have to, it's not that it's not okay to understand what's happening in the world, but we can't let the headlines constantly knock us off course. So we have to figure out a way mentally to somewhat ignore the headlines. And then the last piece of this, again, equally as important of the last four that I shared, is to start with some sort of plan. The world is uncertain, but when we do planning, we can bring some certainty into our lives because we can control how much we're saving every year, how much we're spending every year, how much we think we might want to spend in retirement. When are we going to start our income streams? We could start Social Security at 62, but if we do some planning, maybe it makes more sense to wait for a higher security amount, our Social Security amount per month, and wait till we're 67 or maybe even age 70. But there's so many, there are enough variables for us to control. And I think there's really 5 core. You can add a couple extra to the list of planning. So you're talking about 5 to 10 variables. That's still a lot to keep just mentally in line in your head, particularly when it's got to be over a timeline, a 20, 30 year period. So whether you write down a financial plan, I'm a big believer of writing down a 1-page plan, drawing out a timeline, seeing when our different income streams are going to start, depending on our age. So whether it's we draw it out or we do this through financial planning software, again, readily available, if we're able to put something in place, and it doesn't have to be overly complex, it really helps us, guides us on that journey. It helps us with avoiding FOMO fretting. It helps us with patience and longevity and investing. And it brings all these pieces together. And I think it gives you a really good shot at achieving your goals of financial freedom in retirement. And most importantly, give you more peace of mind so that you end up with a happy retirement.
I love it.